Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about JINHAI Medical Technology Limited annual report. JINHAI Medical Technology Limited offers a diverse range of businesses and services across various sectors. In the medical field, the company provides minimally invasive surgery solutions, medical products, and related services in China and Singapore. In addition to its medical offerings, JINHAI Medical Technology Limited also provides non-medical services such as manpower outsourcing for building and construction contractors. This includes ancillary services like warehousing, cleaning, and building maintenance. The company's portfolio extends beyond these sectors with the provision of IT services and engineering design consultancy services. Furthermore, it offers dormitory services to cater to the needs of its clients. JINHAI Medical Technology Limited also engages in the sale of graphene material products, marking another significant area of business for the company. JINHAI Medical Technology Limited market capitalization of $12 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that JINHAI Medical Technology Limited holds a significant advantage in their industry. JINHAI Medical Technology Limited trades at a higher price-to-book ratio of 36.81 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 44% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified from the extracted summaries. On one hand, revenue growth is primarily driven by the PRC market's 16% increase in revenue and the significant growth in products segment with a revenue increase of $29,964. Additionally, the minimally invasive surgery solution and medical products and related service fee saw an increase of plus 40.37. On the other hand, revenue decline is attributed to several factors. The Singapore market experienced a 15% decrease in revenue, while rental income from dormitory services decreased by 65%. Furthermore, the services segment saw a significant decline of minus 3,514, and handling fee income declined. Other contributing factors include government grant increases that were not enough to offset declines, dividend income from listed investments, interest revenue, and subleasing income. The financial performance of a company has undergone significant changes between FY 2024 and FY 2025. A notable decline in net income is observed, indicating a decrease in the company's overall profitability. This downward trend is further exacerbated by a substantial drop in gross profit margins. Gross profit margins, which measure the percentage of revenue retained as profit after accounting for direct costs, have decreased from 22.8% in FY 2024 to 15.5% in FY 2025. This significant decline suggests that the company has experienced increased pressure on its bottom line due to rising costs or reduced pricing power. The combined effect of these changes is a decrease in net income, which can be attributed to the erosion of profit margins and potentially other factors such as increased expenses or decreased revenue growth. The exact reasons behind this decline are not specified, but it is clear that the company's financial performance has deteriorated over the past year. The financial performance of a company can be gauged by its ability to generate positive operating cash flow. Unfortunately, the current situation for this company reveals a concerning trend. The total operating cash flow has been in the negative, standing at $12,657. This indicates that the company is struggling to cover its operational expenses and generate sufficient revenue to sustain itself. The lack of positive operating cash flow raises concerns about the company's financial stability and ability to invest in growth initiatives. It also suggests that the company may be relying on external funding or debt to meet its operational needs, which can lead to increased financial risk. To improve its financial situation, the company will need to focus on increasing revenue, reducing expenses, and optimizing its cash management practices. The company's debt level has undergone significant changes over the past year. According to the financial statements, total liabilities have increased from $26,088 in 2024 to $36,872 in 2025, indicating a substantial rise in debt. Furthermore, the carrying amount of investment properties pledged as security for borrowings decreased from $21.3 million to $18.7 million, suggesting that the company has taken on more debt. However, despite the increase in debt level, interest expenses have actually decreased. Finance costs dropped by $0.1 million in FY 2025, and interest expenses were lower due to a reduced gearing ratio. This suggests that while the company's debt level may be higher, it is managing its interest expenses effectively. Overall, these changes indicate a shift in the company's financial position, with increased debt levels but lower interest expenses. Management is signaling a shift in the company's financial strategy. One key aspect of this change is the adoption of a more effective approach to managing internally generated funds, specifically for acquiring listed securities. This move suggests that the company is looking to optimize its investment portfolio and potentially increase returns. In addition to this strategic shift, management is also prioritizing risk reduction. By maintaining an adequate level of cash and cash equivalents, the company aims to mitigate credit risk and ensure financial stability. This proactive approach to managing risk demonstrates a commitment to prudence and long-term sustainability. Overall, these developments indicate that management is taking steps to enhance the company's financial performance and position it for future growth. That concludes the financial summary for JINHAI Medical Technology Limited. Feel free to comment below, and I will be happy to answer them when possible.